Joining us now for more, CNBC senior markets commentator Mike Santoli and senior economics reporter Steve Liesman is here as well. Steve, it says here you need to go first. Is that okay? You need more time?
I don't need more time. Thank you. Real quick, jobless claims up a little bit, 217. Still a good sign in the jobless market. You know, it was like, used to be 300 was the number we got concerned about. I think that number fell to 250, so we're still well below that. We're still on track. The jobless claims number would tell us that the job market's healthy. The productivity number is a little weird. There's declines in several sectors of productivity. Manufacturing productivity is down. Non-durable and durables both down, but the total business is what's up. So we just want to be a little careful to watch that productivity number. It's a good number. It's a solid number. It goes along with a pretty decent growth, but we're going to want to watch to see if manufacturing productivity can rebound again. And that's all I got, Joe.
That's all you got. All right. That leaves it. You're going to have to do the heavy lifting then, Santoli. What do you got?
Well, I mean, I think it just confirms the baseline view. The U.S. economy seems to be plugging along. It hasn't really missed much of a step. Now, the bond market's been relaxing already. The stock market was going to have this sort of almost 1% pop on the overnight news with renewed plans for China talk. So this all makes sense to me, you know, that we went down from S&P 3,000 on the new tariff move and the kind of worsening of relations there. Now we're already bouncing a little bit at the top end of the range. So now we have an excuse to test above it. And I do think that, hey, guess what? We re-steepened the 210 Treasury curve, the thing everyone was sort of over-concerned with last week. So we'll see if real buyers come in and it's not just kind of a mechanical pop. Like I said, just under 1% looking right now.
Joe, can I just ask Rick a question? Because he said some interesting stuff, I thought. Hey, Rick, you said two things. First of all, this idea that Draghi's not going to deliver what the market expects next week. I don't know how much, what's the word I'm looking for, disappointment from the ECB is built into the market. And the other thing, picking up on what Mike was saying, does the bond market have to test this rally that it's had? I mean, this is a fast and furious rally, to coin a term, right? And does it have to go check out the downside here now, Rick?
Generational rally. Yeah, generational rally.
Yeah.
You know, we're getting in between two really huge aspects, and to me, it's really exciting. 209 is a really huge area for 30-year bonds. When it traded through there, it was lights out, okay? 136, 137 is the massive double bottom all-time low ever in 10-year note yields. If we get above 209 before we violate 136, I think the all-clear sign can be shown. As a matter of fact, I think I'd be a little nervous if I was too long looking for lower rates because snapbacks could be painful. So very interesting setup. And as for looking for less out of the ECB, it's all around us. Now, it's not huge yet, but you could see it simmering. You could see, you know, tens to twos. I don't think the inversion means much. But the fact that it isn't, the fact that actually Europe's rates started to bubble higher before ours yesterday, this is all very significant.
So, Rick, I mean, it looks like, I wonder if we got to think about a central bank disappointment next week. If Draghi delivers less than is expected, if Powell gives only a quarter, Mike, is that like a catalyst for a sell-off next week from the central banks?
At least from the Fed point of view, I don't think a quarter point in itself is a disappointment if everything else is lining up, right? If it doesn't seem as if the Fed is ignoring timely worsening data from the U.S., which it doesn't really seem to be the case. So I don't know. I mean, look, we're still in this kind of nervous trading range zone. I think the market has benefited in the last several days just from how negative sentiment had gotten, how cautious people got. They looked at this buying panic in bonds and said, wow, I got to step aside because I don't really know what's going on there. So that's being relaxed. There's a little bit of pressure being let out on the valve there. How far it goes, I don't really know. I'm sure the market's going to ask for more after a quarter point if it gets the quarter point. But whether it gets it or not,
everybody's assuming they're going to do a quarter. I'll tell you what, I still think there's a chance they don't. Now, it's not a huge chance, but I still think it's out there.
Well, you've got some voices saying that, and that's so it remains in play, I would say.
I think a quarter's pretty secure here. I think the guys who are looking for 50, but I think what Mike was alluding to was the guidance that Powell gives us. Does he repeat mid-cycle adjustment? I'll bet there's a reporter or two who's going to ask him, Mr. Chairman, is this still a mid-cycle adjustment? And kind of goad him into whether or not he wants to use that language again, or is this now the beginning of an easing cycle? And I think the market's very sensitive to that. I just think we've had
Why
this.
don't we start goading the politicians to get more busy with fiscal policy instead of driving Jay Powell crazy? He misspeaks. You know what? Anybody with that kind of pressure, the weight of the world's on this man's shoulders.
Exactly.
And even though Chuck Schumer says the only people that can help us now are the Fed, that is the laziest, craziest comment I have ever heard from somebody in Congress for more decades than I've been following markets.